Contrary to popular belief, the market can move in three possible ways. Not two, but three. Up, down, and sideways, or unchanged. Knowing which one and how to trade them is going to be what separates the pros from just having a lucky trade. So today, let's talk about how you should trade it, fade it, or evade it. Oi there, trader, it's Phil, and welcome back to the Anti-Investor Stocks and Options Trading Podcast, where we talk about what really works and consistently wins at trading the financial markets. My goal is to give you the right tools, the correct rules, the software to assist you, a community to support you, and if you'll allow me, to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. Now then, let's get back into it. So, the simplest way to ensure you're on the right side of market movements is to have a systematic way to recognize what phase of movement the market is in. And more specifically, you want to define and refine everything that or the decisions that you could possibly make. And again, obviously we're talking about the trend today, so the same thing applies to what your understanding of the trend is. Again, we want to be able to define an uptrend, a downtrend, and ranging markets. And no matter what type of trader that you are, you want to be able to define the directional bias that you're looking for or wanting, or to be fair, to avoid. Maybe you should sit on the sidelines. So you need to have a robust system just to define the trend. Because if you're a trend trader, you want to be buying the trend. If you're a counter trend trader, you want to know what the trend is. If you're a range trader, well, guess what? You want to know what the trend is and what the trend isn't. So as a new trader, you want well-defined rules to avoid subjectivity. Heck, even as a 30-year market veteran, I want that more than ever. I don't want to really be thinking a great deal about what I'm doing. I want to be able to look at what I'm expecting to see and place the trade that I'm expecting to place. And I don't really want to have any subjectivity in my decision-making process. I hate that subjectivity element because it often creates second guessing. And for me, that never really went away until I started to have a pre-trade checklist, just like a pilot would have a pre-flight checklist. So I know what I'm doing, when I'm doing, why I'm doing it, every juncture, and all the decisions that I make have rules for. So that's my preference. That's what I like. Again, systematic rules do all of this for me. Anyway, back to the market trend phases. There's a lot of ways that this can be accomplished, and there's no single method that's foolproof and works 100% of the time. Now, one of my more popular ways to trade the trend, which my students love, is using moving averages. A simple 250 period moving average can be used, and look for a crossover. Now, just because you have a crossover doesn't make it an automatic bullish trend or bearish trend, but it does give you a longer term trend bias that doesn't change very frequently. And again, bullish and bearish biases are what you can look for. Again, a bullish crossover, generally you're looking for a bullish trend. A bearish crossover, you're looking for a bearish trend, so buy the dip and sell the rally. And I outline my system for trading the trend in this way in the very first episode, so if you go back and listen to that, you'll be able to have a good understanding of what I'm doing in relation to the moving average system that I described there. So that very simply takes care of the uptrend and the downtrend, and it may surprise you even further that while movement averages are first and foremost a trend trading tool, they can also be used to identify ranges in a very mechanical manner. Now this time we're going to use a slightly faster combination of moving average, a 20 period and a 50 period moving average. And when those two cross over in the last 100 bars, again, so it's relevant to any time frames, the last 100 bars, you have the 20 crosses back and forth over the 50 period moving average. You'll start to have warning signs that a range may be developing. So if you have two crossovers, that's your warning shot. Hey, a range may be imminent. And if you look at the charts at that point, if you're a little bit more experienced, maybe you can see a visual consolidation that you can draw a box around or identify. But definitely when there are 3 crossovers, so the 20 period moving average has gone above and below the 50 period moving average 3 times in the last 100 bars. Again, you notice how I've defined this. Again, just a little sidebar here. You listen to the definitions that I'm using. They're very, very specific. And this is what I mean by have a rule to define what you're looking for. So 3 crossovers in the last 100 bars. On a 20 and 50 period moving average. At that point, I will be making a statement. There is a consolidation. It is a statement. The only thing that I don't need to know is what it's called. Again, because consolidations come in many forms and variations. Again, the simplest thing to do, which is what I've always done, is draw a box around it. Find the highest high and the lowest low in that time period that you've identified. And maybe the consolidation goes on for longer. But in the last 100 bars, you've got this flip and flop of the moving averages, and the only way that happens is if there is a consolidation. There's no subjectivity involved. And again, if there will be also from time to time where you're not going to be able to define that consolidation. Again, just draw a big box around it. Just take the highest high and the lowest low in that time range and call it a consolidation. And then you can trade appropriately. You can either wait for a breakout, you can trade the range if you're a range trader, and again, you're waiting for a trend resumption to start, in which case you're looking for a breakout. So you've got the tools at your disposal to identify a well-defined trend, a well-defined consolidation. And again, the majority of the time in trending and ranging markets, you're going to see well-defined boundaries. You're going to see a well-defined, stair-stepping approach. It's going to rally away from the moving averages. It's going to dip back to the moving averages, rally away, dip back in. We've just seen that in the last 6-8 months. You've had some very strong trending markets on very various instruments, the indexes and individual stocks. And again, same with consolidations. The majority of the time, you're going to see a well-defined upper and lower boundary. Again, it might be a horizontal consolidation. It could be rising or descending, in which case you might call it a channel. And although it's pointing up and down, it's still contained within boundaries. So don't mistake a channel pattern for trending market conditions, because it's not. It's in a consolidation. So draw those boundaries and treat it like a consolidation. And again, as I've already said several times now, at that point, draw a big box around the consolidation and call it a range. And then you can apply one of my 6 money making patterns. Again, you can buy the dip, you can sell the rally, you can buy range lows if it's in a range, you can sell range highs, you can buy the break of range highs or sell the break of range lows. And that really is the 6 money making patterns that I prefer. Again, the 2 cousins are counter trend trading. I don't really counter trend trade as such. It doesn't really sit well with my personality. But if it's your thing, then guess what? You need to know what the trend is to be able to trade counter trend. So again, if you're a dip buy, you'll know when to trade it and when to wait. Again, because no one buys the rally, you wait for the dip in the context of a trend. So you can start to change the way that you phrase things. Instead of saying buy the dip, well, you've got a way of defining what the trend is. So it's buy the dip in the context of an uptrend. Well, what's an uptrend? An uptrend for me is when the 50s crossed over the 200 period moving average and we're at least 30 bars into that trend, then I can start buying dips. I want to see price push away from the moving averages and buy dips back near the moving averages. And again, I described that process in more detail in the first few episodes of the podcast, so go back to the very first one and listen. Again, if you're counter trend, know what the trend is so you can trade, so you can fade the trend. Again, it's not something that I prefer to do. But nonetheless, people do make good use of it. If you're a short seller, you know when to sell the rally in a downtrend. Same as buying the dip in an uptrend, you just sell the rally in a downtrend. If you're a range trader, you know where there's a range, and again, you can trade the range lows, the range highs, you can wait for the breakouts, etc. And PayPal's a really good example in the last couple of years of all of these things that are developing at once. You've got a nice strong uptrend, a nice strong downtrend, a nice multi-month consolidation. You can see the phases. If you just overlay those moving averages onto the PayPal charts on the daily, you'll see all of these phases of movement so that you can now trade it, fade it, or evade it. So if you like what you heard here today, be sure to follow and listen from the very first episodes where I map out several of my most profitable money-making strategies. More recently, I did map out my SPX system. It's just a few episodes ago. In fact, I think it's the last episode that I did. Again, I've recorded a few of these in advance, so they all blur into one, so forgive me if I don't know it was the most recent one. But the most recent published one prior to this one should be the SPX process. Anyway, if you have questions, shoot me an email, phil@antivestor.com. Let's start the conversation. I've always got a lot of time for serious traders because what I do isn't right for everyone, and maybe I can put you off in the right direction. At the very least, I promise that to everyone. So thank you all for today. Thank you for giving me your time and attention, making me a part of your regular routine. Have a wonderful day, and I'll see you at the same time next time. Keep in mind that options on futures, stocks and stock option trading involve a degree of risk that may not be suitable for all investors. There is a risk of loss in every investment that you make, and it's your responsibility to assess the risks of your decisions. Past performance is no guarantee of future performance, and Antivestor provides educational information and does not provide financial advice.